Welcome to the Amber Data Derivatives GUI demo. So basically what I'll be showing here is how to navigate our GUI application and some of the features that we have here on the app. So kind of jumping into the current tab, this is really essentially the first thing that people will look at. So what we have here on the left-hand side is just kind of a ribbon of the latest changes in all the, call it at the money vol, 25 delta risk reversals, 25 delta flies, things like that. It defaults to the past 24-hour change, but I could see a week over week change if I want to see what that looks like. And so you'll see that here on the left-hand side. On the right-hand side, what we're really looking at is the relationship between realized vol and implied vol. So this is what we call the variance risk premium, or the carry of being long options. So I can pick out a date range. Let's say I want to look at starting June 2023 to now. I can pick out the interval range as well. So the intervals can show me the rolling window of the realized vol calculation. And then at the bottom here, we can see the implied vol as well. So this is all looking at the money vol. We can see here that we just had a sell-off in Bitcoin, so realized vol kind of shot up. But we can see essentially the relationship between implied and realized side by side. If I scroll down a little bit more here, on the right-hand side, we have the volatility smiles. So this is essentially the skews for all the expirations. All these charts are resizable, and you can place them around your layout the way that you like. One more point on that, you can also make a custom dashboard by clicking this little bookmark tab and clicking charts and saving them to your own custom dashboard section. On the right-hand side here, we have a time lapse of the term structure. So I can see where is the term structure right now versus where it was 7 days ago. So we can see Mark IV versus Shadow IV. Shadow IV is really just a Mark IV time lapse. And so that gives you a really good idea of what that looks like. We also have a term structure comparing Bitcoin vol and ETH vol side by side. Really interesting phenomenon here where ETH vol is cheaper than Bitcoin vol. On the left-hand side here, we have fixed strike analysis. So essentially here, let's say I want to look at this quarterly September expiration. I can do that, and then I can look at the fixed strike analysis. So let's just say I want to look at $27,000 strike, 28,000, 29,000, 30,000. I can really get a good idea of how those move together. I can expand this window a little bit so it's a little bit more data, and really get a good idea of, in the fixed strike space, what is vol doing and how is that moving and what does that relationship look like. I can scroll down a little bit more here. We got a term structure. This is a slightly different version. This is going to be term structure with the forward vol superimposed. I can click on and off different realized vols as well. So if I'm looking at 30-day realized in the red line here, I can see where the implied space is in terms of at the money vol. Here's a time series of that term structure as well, so you can get a good idea of what that looks like over time. I can make a longer date range. Let's just say I want to add a year of data to this. Now I can see the term structure over time. I can go ahead and change the interval as well. So if I want to look at a more intraday level basis, I can go to 15 minutes and see what that looks like. I can go as slow as 1 minute. On the GUI, those higher granular intervals are going to be limited in terms of history, whereas on the API, you can get a longer history of that high granularity stuff. If I scroll down a little bit more here, I can see the constant skew. When I say constant, I mean these constant expirations, 7 days till expirations, 30 days till expirations, so on and so forth. And then here I'm looking at call implied volatility minus put implied volatility. So in this case, I'm looking at a 25 delta space. And it gives me a really good idea of essentially how expensive are calls versus puts. What is the symmetry or asymmetry of these curves? And so we can see we had this big, nice vol event here on the Bitcoin sell-off, and skew moved a lot, and now we're kind of recovering here. If I scroll down a little bit more here, again, skew, this is going to be divided by at the money volatility. So instead of looking at outright vol differentials, we're looking at outright vol differentials divided by at the money vol. So it gives us a percentage in terms of at the money vol. If I keep scrolling through here, we'll see some more basic stuff: open interest by strike, by put calls, by expirations, volumes, by those same things, strikes, put calls, expirations, stuff like that. And if I scroll down here, I can see a buildup in open interest over time, and so on and so forth. And then let me just go here. We have a butterfly chart as well. So it's going to show us the 25 delta butterfly over time. What does that look like? So this is the current order book tab section, and this is the type of charts that you'll find here. So the next section that we like to check out is the historical section. So this is basically one of my favorite sections because this is where we have some of our most fancy charts, so to speak, or proprietary charts. So obviously we've done a lot of work on term structure. These two charts up here are going to be more term structure charts. What I'm doing here is I'm looking at year to date. This is the default, but I can change the date range as well. And what we'll see here is year to date, or whatever the default range I'm picking, I can see the distribution of the term structure. So you basically have box plots here where the wicks are going to be the maximum and the minimum extremes. The line through the box is going to be the median. And then the lower end of the box is the lower 25th percentile. The upper end is the upper 75th percentile. So we can see here that the term structure is kind of below the lowest 25th percentile across the board. So year to date, we're in the lower 25% half of where the term structure has resided. On the right-hand side here, it's the same thing, but this is in terms of realized vol. So it's just a great way to compare these side by side. This chart on the left, it's just basically weekly volume, kind of easy, self-explanatory. You can look at it in terms of notionals, or in terms of premium traded, and then the blue is block trades, the orange is on-screen trades. The chart here on the right is pretty interesting. This is going to be really giving us a good idea of the realized move in terms of Z-score. So what we do here is that implied volatility is essentially options market best estimate of the volatility that we'll see in the underlying market. And so what we do here is we take, in this case, we're looking at 7-day at the money implied vol, but I could go to 30, 90, 180, all that stuff. And what we do here is we take this annualized number and we convert it to a daily implied move. And we do that by dividing the annualized number divided by square root of 365. Gives us a really good idea of, what is one standard deviation of close to close volatility in Bitcoin in this case. And so we can see here, this big sell-off today was almost a 5 standard deviation move in terms of what the option market was implying. So obviously the next day, this is all daily data, the next day implied vol shot up a lot to sort of reprice higher in terms of what Bitcoin can do. If I scroll down a little bit more here, I can see the volatility footprint. So this is going to show us, we pick out an expiration of choice, and it's going to show us where the current skew resides versus sort of the recent history. So the past couple of weeks or 15 days. I can click drag to get a better zoomed in look. And now I can see, okay, $28,000 strike, what does that look like? Where has that been recently? I can hover and I can see 5 days ago, we were at 43. Now we're at 37, so on and so forth. This next chart is one of my favorite charts. What we're doing here is we're looking at a term structure richness or cheapness. And so typically what we've done is we've done the constant maturity term structure of 7 days till expiration, 30 days till expiration, 60, 90, 180. And in this case here, what we do is that we take a ratio of all those and we take the average ratio. And so a reading of 1.0 is a perfectly flat term structure. If we're above 1.0, we are in backwardation. And so we can see here, backwardation peaks kind of top out at the same levels. So we had the COVID crash, we had the May 2021 sell-off, then we had Terra Luna implosion, then we had Three Arrows Capital implosion, then we had FTX implosion. And so you can see backwardation essentially reaches these peak levels around the same magnitude. So if you're trading vol, this is a really great indicator of when is the front end a little too expensive or topping out, so to speak. And the same thing here in contango environments. So when we're below 1.0, we're in a contango environment, and we can see sort of peak steepness around the, call it 75% or 80% handle. And this gives us a really good idea of when the front end is very cheap. And so we can kind of see we bounce off these levels as well when we're coming out of a low vol environment. Let me jump here to the butterfly index. So this is a really good way to look at the price of convexity. So what we do here is we take the DVOL index, the Bitcoin VIX, we divide it by at the money 30-day implied vol. And now what we're doing is we're isolating the curvature. And so we can see here, this ratio, I go to index ratio instead of spread. Spread is the difference between the two. Index ratio is the division between the two. And so what I can see here is that the upper 90th percentile is the spread line, the lower 10th percentile is the green line, and a dashed line is the median. And so we can see when we're sort of, call it FTX levels, wings become really expensive. And then we had this recent sell-off, wings got really expensive. And so we could get a good idea of, where's the value at, or where's the rich and the rich optionality to sell, so on and so forth. Here we have the shadow delta. Again, shadow really just means time lapse, just kind of a cooler way to say it. So basically what I'm doing here is I'm looking at it into the delta space so we can see the time lapse over time, current, yesterday, 2 days ago, so on and so forth. And I can see that evolution of skew. Again, here I can do the same thing. I pick out an expiration of choice and look at that skew evolution in the strike space. If I scroll down a little bit more here, we have some of these time series again, but instead of fixed maturities, it's going to be the active maturities. Here I can look at the changes in open interest. And then lastly, these 3 charts are some of our most proprietary charts. We spent a lot of time figuring out the true direction of aggressors. We do the assumption that passive is dealers, or passive participants are dealers in the space. And so what we do here is we take the trades of every contract since inception, we tally it up, and we get a good estimate of how dealers are positioned in the space. So I can click here and look at different days in the past and get a really good idea of how dealers are positioned. So we could see, right before the sell-off, dealers were sort of long here in a decline in spot. And then kind of post sell-off, we can see how that changed. People sort of panic bought a lot of optionality, and now dealers are short all that optionality. So makes a lot of sense. Vol rallied, dealers on the other side of that vol rally. So this kind of relaxation and vol is probably really good for them. On the left-hand side, same type of chart, but all the expirations are now broken out. And then lastly, this is going to be a time series of that debt gamma exposure over time. And what we can see here is how does that move. So Q2, June 2023, we had a huge expiration cycle on Deribit. Dealers were net short a lot of optionality there. Then that expiration rolled off, and you can see that this chart just spiked right back up, and now we're back sort of in that normal territory. So that's another kind of anecdote and a good way to contextualize how people are positioned in this market.